and welcome to The Chart Show. I'm Victoria Scholar, and each week I'll be sharing my analysis on three key stories that are getting a lot of attention among investors. I'll be breaking them down not just from a fundamental perspective, but with technical analysis on the charts as well. This week's three charts are the FTSE 100 after Friday's global market sell-off, easyJet, which reported full-year earnings on Tuesday, and Twitter, which appointed a new CEO. The FTSE 100 lost 266 points on Friday and closed down 3.6%, suffering its worst day in over 16 months amid a global market sell-off sparked by concerns about the Omicron variant of the COVID virus. US and Asian equities also sold off, while oil fell by more than 10%. Travel stocks were hit hard, with shares in IAG, the parent company of British Airways, down by as much as 20% at the open, while the South African rand was nursing heavy losses. However, the so-called stay-at-home stocks were back in fashion, with shares in Zoom, last year's poster child of the working-from-home trend, jumping alongside food delivery businesses such as Delivery Hero and HelloFresh. The start of this week has seen considerable volatility, with moves in both directions as the world scrambles to try to digest the threat from Omicron, with many investors on Monday buying the dip, assuming the selling was overdone. But pessimistic comments from Moderna's CEO on the possibilities of another vaccine spelled more trouble for markets on Tuesday, leading to selling once again. Taking a look at the chart of the FTSE 100 on the long-term picture, we can see the clear ascending trend line since the 2020 trough, with higher highs and higher lows. Price action since Friday's sell-off has seen the index pull back to test the ascending trendline, but fail to break below as of yet. Unlike many other global indices, the FTSE 100 is yet to breach its pre-COVID peak and still has some distance before it can test that resistance once again around 7,600. The next major resistance held before that is at 7,200, while there's significant support at the psychological round number of 7,000. A break below could spur further selling. Shares in easyJet swung between gains and losses on Tuesday morning after the company delivered full-year results. At one stage, the stock was up by 2%, but it got caught up in the broader selling and in fact closed the day down by more than 1.5%. The low-cost carrier said that Omicron had already dented short-term bookings. Its CEO, Johan Lundgren, warned that many uncertainties remain ahead as we head into winter. The company reported a full-year loss of £1.1 billion. That leads to losses of more than £2 billion over the last 2 years, largely due to pandemic-related factors which are out of its control. On a brighter note, easyJet sounded more upbeat about its outlook and told investors that it's already seeing strong demand for flights next year in summer, with many people, of course, desperate to book a trip after COVID. Let's take a look now at the technicals, because even before the pandemic, shares in easyJet were under pressure, with the stock in a downtrend dating back to 2018. The near-term trend supports the long-term bearish view as well, with lower lows and lower highs since the peak this May. After a very challenging 2020, shares began to change course last November with a retracement of around 60% of the COVID-driven losses. However, it failed to break above resistance at the 61.8% Fibonacci retracement line, and since the May high has suffered a 45% slump in its share price. The stock has now broken below psychological support, turned resistance of 500 pence, which could pave the way for further declines. Twitter's CEO Jack Dorsey stepped down on Monday, with shares jumping as much as 10% on reports of the news before it was officially announced. The stock pulled back to a gain of 3.5% before shares were halted on the New York Stock Exchange when the news was announced, and the stock ultimately ended the session lower. Parag Agarwal, Twitter's CTO, has been named as Dorsey's successor, taking over as chief executive. The change in leadership comes as a welcome development to many investors and no shock to its board, who were reportedly preparing for Dorsey's farewell for more than a year. Agarwal is now the youngest CEO in the S&P 500 at age 37, pushing Mark Zuckerberg into second place. Shareholders are hoping that Agarwal can restore confidence in the microblogging site. Its latest earnings were a disappointment, with revenue guidance and monetizable daily users falling short of expectations, sending shares down double digits on the day. Let's take a look now at the chart of Twitter, because the stock has been struggling lately, shedding more than 45% since the February high. Taking a look at the chart, we can see that shares are trading at the lowest levels since November last year. This year, the stock has been under pressure, trading in a descending trend line with lower lows and lower highs. After a short-term reversal in October, the descending trend line was replaced by a much steeper trend line, with losses accelerating, with a break below support turned resistance at $50 a share. In order to believe that the downtrend is over, the stock needs to break back above the May trough at 45 and above 50. But for now, from a technical standpoint, it looks as though the downtrend remains intact. However, the pace of declines could be unsustainable, with the potential for some leveling off.